Thank you to all of you who already joined this webinar. Please allow me to introduce myself. My name is Rahmat Dewanto, the Secretary General of Indonesia Gas Society, who is also working in commercial division of Pertamina Hulu Indonesia. In the next 2 hours, I will become the moderator for this event. After 2 successful webinars, the first one on 9th of May regarding the impact of COVID-19 and low oil price to the LNG and gas business in Indonesia, and the second one on 16th of May with the topic of the impact gas prices to the industry competitiveness in Indonesia. On behalf of IGS, we would like to express sincere gratitude to our honorable guests who already joined here, Ms. Sinan as the Vice President Analyst Gas and Power Research in Restart Energy, and Mr. Kenneth Wu as the Regional Manager of Asia LNG in S&P Global Platts. Before we proceed with this event, I would like to give a brief explanation about the Indonesian Gas Society. I think we can share the slide, Mas Budi. Indonesian Gas Society is a non-profit organization that supports the development of the Indonesian gas industry from upstream, midstream to downstream, which includes commercial, technical, operational, and HSSE aspects. The IGS was established in June 2014 and acknowledged as the active member of the International Gas Union. The vision of IGS is becoming an independent, effective, and reliable organization of energy and professionals to facilitate close and effectual collaboration among stakeholders towards advancing the Indonesian gas industry through sound policies and strategies and improve human quality, business process and practices, and new technologies. And to achieve our vision, we promote natural gas as a key source of sustainable energy, provide strategic input to the policymaker, promote the development of gas industry through all stakeholders, facilitate the equitable distribution of information and technology related to the gas industry in Indonesia. And finally, of course, provide benefits for all members. Thanks to all IGS members who continue to support our event, including this webinar. In this webinar, we would like, this is our members. We already have more than 20 members now. So in this webinar, we would like to discuss about the impact of COVID-19 to the LNG supply demand in the Asia Pacific region. We will have 2 presentations followed by Q&A session at the end of the presentation. I'm inviting the audience to post the question either in the chat provided in the Zoom or chat in the live YouTube streaming. Then I will collect the question at the end of the presentation. Ladies and gentlemen, LNG has almost become a global commodity now. The dynamics of LNG market in Europe, Asia Pacific, and even in the US are now connected each other. So it is good to understand what is happening globally prior to see the impact of COVID-19 towards the Asia Pacific region, and of course, at the end, the impact to the Indonesian market. We have a very dependable guest here to explain regarding the fundamental energy supply demand from the global perspective to the region. She is a vice president at Restart Energy gas market team based in Singapore, where she is focusing on the LNG markets as well as product development. Her project includes LNG market entering strategy, cost of LNG supply, analyzing supply and demand, flows, storage, and prices on different gas hub, and tracking global LNG trades and prices. She holds a Master of Science degree in finance from BI Norwegian Business School. She was previously a senior analyst and content manager at Thomson Reuters and analyst at Econ Pöyry Management Consulting in Norway. Please welcome Ms. Sinan.
Thank you. Thanks a lot for the kind introduction. Rahmat.
You're welcome. Yeah. You're welcome. Now you are free to deliver your presentation.
Yeah.
To all of us.
Can you see my screen, like full screen? Okay.
Yes, perfect.
Yeah, great. Do this. Yeah. Thanks everyone for joining, and thanks a lot for the invitation. And I'm really glad to be here and share the view from Rest Energy gas markets. So today we will go through quickly the market review on global basis. Then we go to the COVID-19 effect on supply, and then COVID-19 effect on demand. Then afterwards we can see the implications for LNG balance and prices in a bit longer term. As we know, even though the COVID-19 is quite short-term event, but it may have like prolonged influence in terms of the production, demands, investments. Yeah, this long-term impact. So we have seen the international markets, the gas prices repeatedly being sent to new lows across this month. So if we look at the first line, the gray line here, this is the oil index contract price. We see that it doesn't really have the same shape as the spot ones, because usually in the oil index contract, they have a lag of, let's say, average 6 months in the oil indexation. So the current low oil price is not yet reflected in the oil index gas prices. But let's look at the spot prices first. The Asia spot, which is the red line, we can see that normally in winter it could hit a level of $10, but this year, especially this winter, it's hover around below $4, and currently it's around below $2. The very low prices started from China locking down the border and the industrial business activities, and followed by India and other countries. So now let's hold over around $12. Of course, the international ample supply, or we say oversupplied conditions, basically make all the gas hubs remain at very, very low levels. And let's look at the blue line, which is the Henry Hub price. And we see that Henry Hub prices remain at a level below $2 for the past weeks, and currently it's below $1.7 per MMBtu due to high inventory levels and mild weather in the States, even though it had a bit of spike in April for cold weather, but now it went to normal, so it's quite a bearish market as well. In Europe, the TTF price, the Dutch benchmark price, is now trading below $1.5 per MMBtu, and it's actually lower than the Henry Hub price, which means the Henry Hub, basically all the cargoes, spot cargoes coming from the US, and they sent to Europe or Asia, they're losing money. And so the big spread between the oil price and oil index price and the spot price could give the LNG buyers, sellers some perspectives to see or to look at their contract. So this chart shows the spread between oil linked price and LNG spot price and its impact on the long-term contracts in terms of the financial terms. And this chart shows that South Korea, Japan, China, the largest LNG buyers in the world, and their cost premium for buyers, how much they actually have paid more according to the oil linked price compared to that LNG spot price at that time. So in total in 2019, the three countries combined have paid $33 billion more for the contract they have committed. And so they alternatively, they could get those volumes from the spot markets, but they have to fulfill their contracts, so they have paid this $33 billion more for the past year. In terms of the real flows, this chart illustrates the first 5 months of LNG imports into major importing regions, of course, 2018, 19, and 2020. We see that the total volume in 2020 is still, even though the COVID-19 has impact on LNG demands, but the overall volumes are still higher than 19 and 20. So the bottom right columns are Northeast Asia, the largest LNG importing region. So they still realize a growth in terms of LNG imports, but the growth rate is much lower if you compare 2019 growth over 2018. That's mainly driven by China, which realized a quite ambitious growth in 19 over 2018. But this year, due to the COVID-19 and due to the lockdown, the speeds went down. But on the other hand, Korea has realized a robust growth, especially in their power sector. So that's the reason why, even with COVID-19, Asia still have increased, but at the same time, it's not as much as a year ago. And if we look at Europe, which is the blue columns, same here. In 2020, Europe has, for the past 5 months, Europe has imported around 40 million tons of LNG. And in 2019, the number was around 33. And 2018 first month was around, I think, 15, 16. So below 20. And we see that the increase, basically the incremental parts of this year compared to last year was only 6 to 7 million tons. But the incremental parts of 19 over 2018 is more than 10. I think it's 15 to 18 million tons incremental increase. So we can go to the Europe LNG story a bit later in the demand parts, because when we look at Asia Pacific's LNG demand, we have to sort of look at a global basis to see. And nowadays, as Rahman mentioned, it's not only index, not just a regional play. Then you have to take gas and LNG as a commodity, and we have to consider its global movement. Yeah, so the effects of COVID-19 on supply has definitely affected the operating ones and the pre-sanctioned ones or project sanctioning. Let's look at the currently operational plans. So we listed the operational LNG plants and break down their operating costs into upstream cost, which is the red cost. LNG production OPEX is the brown columns, and the transportation OPEX to Asia Pacific region, to Northeast Asia, and some admin costs and also royalties. And then we see that there are something, there's a blue column called pre-tax liquid revenues. So this is a negative, it's showing a negative value, which can sort of compensate for the costs coming from the LNG parts. So the liquid revenues is because some or integrated projects, they are having oil production, gas production, of course LNG production in midstream. But as an integrated project, the operator can benefit from their liquid revenues. So if you just look at LNG costs, it may be quite high, but if you just take into account the liquid benefits into the project, so the actual cash flow received or spent by the operator could be different. But on the other hand, if you look at the US ones, which are on the right-hand side, so US projects are usually source gas from the grids, namely Henry Hub as a benchmark. So these projects are not benefiting from the liquids part. That's why you can see their operating costs or their short-run margin cost is quite high compared to others. If we draw a line of the Asia LNG spot price, which is a blue dotted line here, assuming at $2.2 per MMBTU, we can see that if you cross the net cost and the spot price, then you have the projects to the left-hand side in the money and to the right-hand side out of the money. So this gives the market a quite clear signal how well and how bad those projects are running. And of course, LNG projects are running, most of them on long-term contract pricing. So it doesn't necessarily mean if your plant is somewhere here and is higher than the spot price, then you have to shut down. No, it's not the case, but it could give quite a clear signal that some plants may have to run at a lower utilization rates or probably have to shut in. And we have seen that for the US ones, like Cheniere operated plants, they have cut productions. Even though there's a COVID-19 quite bad impact on supply, but the LNG supplies and capacities and new volumes keep coming in to the market this year. The chart to the top is a liquefaction capacity additions in 2020. And we see that around 25 million tons of global capacity will be added this year, coming from US, Elba Island, Freeport, Corpus Christi, and Cameron LNG, and 2 from Russia, Portovaya and Yamal. And the Malaysia one's Perminas Rotan, the second FLNG in the country, will likely be happening or coming online at the end of this year. But if the COVID-19 has prolonged impacts on platforms, on installations, then it may be delayed coming online in February next year. But when it comes to the actual production, we think in this year, 2020, 375 million tons of LNG will be produced in total. So this will be a 15 million tons more than 2019 level. Yeah, even though the market is quite bearish, but it doesn't really stop the production coming online due to the capital investments. All the capex is already taken as sunk cost. So as the project is approaching to finish, so you have to bring those volumes online to fulfill also the contracts. And this year, Australia, Qatar, US, Russia, and Malaysia, the 5 countries will be the top LNG providers, and headed by Australia becoming the largest one and overtake Qatar from this year. When it comes to the new projects, this is the total greenfield LNG investments by approval year. And we see that just at a very quick view, we see that LNG project sanctioning was basically almost nothing to in 2020. And in 2019, around 70 or more than $17 billion was invested in the LNG related greenfield projects. But this year in 2020, it was initially planned around the same level as last year. But due to COVID-19, due to the bearish market sentiments, currently there are only $3 billion is on schedule. One's from Mexico and one is Australia, some upstream investments. So most of the projects and investments have been postponed to 2021 and even the year after. So when it comes to the actual projects, this table lists the liquefaction plants that were sanctioned in 2019, which was shown here as the green part in the table. So 72 million tons of capacity of the liquefaction projects were sanctioned last year. And this year, in the orange cells, this project was initially scheduled for this year, FID as well, but currently it's only Mexican one operated by Sempra Energy. The Energia Costa Azul Train 1 will be likely go ahead. The rest of the projects from the US, Qatar, Australia, Russia, Mozambique, Canada, all these projects have been either announced by the operators or have quite clear signal that they won't go ahead anytime soon because of the financial problems or investment cuts. So these projects will be postponed to either in 2021 and 2022, even some of them going forward to 2023. So this corresponding to what we just seen in the investment figures. And we see that the last two columns, this one is capacity in terms of million tons per annum, and this is the cost of supply, including transportation costs to Asia. So we see Qatar gas, among others, has the lowest break-even price for cost of supply to Asia, even though due to the COVID-19, due to the bearish market signal, Qatar gas has already decided to delay the onshore contract award plan, and so follows the FID. So we think Qatar gas will be sanctioned next year, mid next year. Let's go to Asia Pacific. So this chart shows Australia, Malaysia, Indonesia, Papua New Guinea, and Brunei is Asia Pacific LNG producers. In 2020, we think the entire region, APEC region, will produce 140 million tons of LNG. And in 10 years' time, the increase will be just 10 million tons to achieve 150 million tons by 2030. So the increase is mainly from Indonesia, and some new projects we will see in next slides, and so the Papua New Guinea, the PNG extension project, and Papua LNG, operated by ExxonMobil and Total, respectively. When it comes to Indonesia LNG production going forward, this chart shows the Indonesia LNG production by break-even gas price. And we see that as the price level of $1, $2, below $3, Indonesia can maintain a level of around 15 million tons per annum of LNG production. And the currently under construction Tangguh LNG Train 3 will break even around $5 to $6, which means if the market price is around $5 to $6, then this project will make money. And the pre-sanctioned ones, Abadi LNG, has to require the long-term market price to achieve above $6 to incentivize the project's profitability. And we think Abadi will be sanctioned probably in 2022 or even in 2023 due to the COVID-19 impact. So let's go to the effect of the coronavirus on the demand side. Before we look at Asia, the effect on Asia, let's first look at the European markets. So we know that on the global LNG demand side, Asia historically has been quite favored by the operators, by the LNG producers. Usually they would get higher netbacks from Asia than Europe. And Europe is always playing a role as absorber of the excess volumes that we have seen quite clearly last year. But this year things are different because of COVID-19 basically puts a large impact on the total natural gas demand and also on demand basically everywhere. So the movements between these two countries will be slightly different than the historical years. And so this chart shows the European imports by source. We know that Europe continent plus UK has pipeline connections with Norway, with Russia, and with Libya, Algeria in Africa. And Russia has been the largest pipeline or pipeline provider or exporter to Europe, and also is the largest natural gas supplier to Europe. But for the first 5 months of this year, if you compare the red columns, this parts, and with all the previous months, of course, 2018 and 2019, and we see that just the first 5 months this year, Russia imports or Russia exports to Europe has dropped by 28% year on year due to the warm weather, due to COVID-19 on both supply and demand sides, and also the contractual challenges with Ukraine and Poland, which make the Russian imports or Russian volumes to Europe hit basically historical low levels in the recent years. And at the same time, even though the entire Europe natural gas demand is expected to drop this year compared to 2019, but LNG imports actually increased, as we saw in the international market overview slides, mainly due to these volumes that lost from Russia has to be partially compensated by LNG supplies, but not enough because the natural gas demand is trending down this year. And the record low gas price in Europe, taking TTF as the benchmark price, is almost just 50% of the September 2019 price level. And this chart shows the coal gas switching in the Netherlands. The black line is the coal gas switching higher case, and the brown line is the coal gas switching low case. So if the natural gas spot price, the orange line, I say the TTF price, drop within this region, which means some of the coal can be replaced by gas. And if the gas price is higher than range, like the price level we see in beginning of 2018, and this signals a quite tight gas market due to the cold weather, high injections, and supply disruptions that we see both beginning of 2018 and beginning some days in 2019. But if the gas price drops below the coal to gas switch range, which means theoretically the coal can be 100% replaced by gas. Of course, it's not happening in reality, but just theoretically it can happen. And apparently the historical low gas prices this year has put a quite strong incentive and triggering the economical arguments for coal gas switching in Netherlands or in Europe. And going forward, the coal gas switching expect to continue, but with some comeback of coal, as stressed by the TTF forward curve, that the gas will be less replacing coal at the end of this year in the winter, mainly due to in normal winter the price will be higher, will not be so crazy as now. And one thing we have to notice in Europe compared to Asia is that Europe has a vast amount of underground storage, totaling around 110 BCM underground. But in Asia, it's not the case. China has less than 4% of their gas capacity underground storage. But Japan, as the largest LNG supplier or LNG, the largest gas, not supplier, importer and gas importer, they have zero underground storage. But Europe is not is quite unique in terms of the storage, and also it makes Europe has capacity or has the ability to absorb excess volumes when the global market is oversupplied. And so let's look at the 2020 underground storage levels. So currently, by the end of May or beginning of June, underground storage currently has 81 BCM of gas in the storage. And if you compare at the same period of time, 2 years ago, in 2018 and even 2017, the volume was around just half, around 40 BCM in storage. And if you compare with the bearish 2019, it was around 65 BCM underground in the storage, and we are currently have 15 BCM more in the storage, which means this year Europe would have 15 BCM of less space in the storage to keep absorbing excess volumes from the global LNG markets. And also, if you follow the trend, the storage will be fully filled ahead of time, probably just during the summer. Usually the shoulder months will continue at the end of October, but this year it would likely be fully filled in July or August. Also, we have seen that European LNG buyers sent the cargo cancellations. Like US, they have received the global cancellations, like in June, I think it's around 20-25. In July, it's more than 40 cargoes cancellations, since part of them are from Europe. And also it explains the space in the storage, also explains in the future, Europe cannot absorb as much of the LNG volumes in the oversupply markets as they did last year. So it means if the supply keeps coming in as scheduled, then it will probably send markets even to a more bearish place later this year. Excuse me. Let's look at Asia. So this chart shows Japan and South Korea. Their long-term SPAs locked already in 2020 from different LNG suppliers. We see that Japan has locked 82 million tons of volumes in their long-term contracts, and actually, it's this country is already oversupplied. They probably not. They won't consume this much this year, but as we see growing numbers of LNG importers becoming as portfolio players, they could divert some cargoes to other countries where they have the trading arms and also the regasification capacity shares. And in South Korea, they have locked more than 96% of their LNG demand into the term contract as well, which means these two countries won't have much room for the spot cargo purchase this year. You would see some smaller players, but not much scale. And also the very low gas prices in these two countries have triggered cold gas switching. So the chart to the left is the Japan gas prices versus cold gas switching price. Same as Europe, same logic. This is the cold gas switching higher case, this is the lower case, and this is the Asia spot price drop. It can be above the region, meaning coal is cheaper, much cheaper than gas, and in between is coal to gas can be switched according to the efficiency of the two types of fuels, and the price drop below the low case of coal to gas switching range means there will be plenty coal to be replaced by gas. And similarly, in South Korea, we can see that the coal to gas switching or the gas prices have dropped more compared to Japan under the low case of coal to gas switching. And also the Korean government published a draft of the ninth energy use plan, which is aiming to cut emissions, and by 2034, from 2020 and by 2034, they want to replace as much as possible of coal with gas and renewables. And also, this means gas will become more important in South Korea than renewables going forward. One thing is renewables not quite stable before the battery is improved, and second, the renewables like wind energy and solar energy is not having too much capacity factors. Usually have 15 to 20% of load factor, which is much lower than the load factor of gas. When it comes to China, and we just revised our Chinese energy demands last week. So in 2020, we think at the moment China would import 63 million tons of LNG this year. There was just quite small increase from 2019. They imported 59 million tons, so only 3 to 4 million tons more. And the red line shows the China energy demand, and the columns are the Chinese long-term contracts volumes with different suppliers. So this leaves around 12 million tons of uncontracted volumes in the markets, so which could be sourced from the newly signed contracts or from the spot market. And we see that as CNOOC is opening up their regasification capacity to third parties, and the smaller players would think a way of importing LNG into trucks or utilizing the capacity from CNOOC. So we'll see growing number of independent or smaller players in China to be active on the LNG purchase this year on spot markets. So around 73% of global LNG demands will be in Asia during the next 10 years. And the red one is Asia LNG demand or LNG consumption. And this will be definitely dominating the LNG markets going forward, mainly driven by, of course, the traditional players like Japan, South Korea, Taiwan, and also China, as well as the emerging LNG importers like Bangladesh, of course, India, and some other smaller players. Of course, we see that Myanmar started importing LNG just from this week as well. When it comes to Indonesia gas consumption, so what does this LNG market dynamics mean for Indonesia domestic LNG, gas consumption? We think Indonesia is expected to consume around 40 BCM of gas in 2020, 25 of which is used in industrial sector, and only 7 BCM will be consumed in the power sector. And the rest will be residential, commercials, and transportation, and losses from the processing phase upstream. And in 2030, the Indonesian domestic gas consumption would reach 53 BCM. So in 10 years, around 13 BCM increase in Indonesia. But as we see here, by 2030, around 35 BCM of gas to be consumed in or by the industrial sector. And the power sector will be only 11 BCM. And so we see the increase of 2030 compared to 2020. The gas consumption in the power sector is only 3 to 4 BCM more, but in the industrial sector will be 10 BCM more, which means that the driver will be coming from industrial sector. And also in Indonesia, coal is still on the agenda of the government plan and also favored by the governments, and just because the government want to secure the supply, and also of course coal has relatively lower costs than gas plants. So the implications for the LNG balance and prices by taking into account the COVID-19 effect on the operational LNG plants and their impact on 2020-2021 gas demands, and also the long-term impact in terms of the sanctioning and investments, and also the demands side on LNG, natural gas demands and different sectors. So what does it mean for the balance going forward? So this chart shows the LNG production by life cycle. The brown ones are the producing fields divided by countries, and so the yellow ones are the currently under development projects. So we think by 2030, around 140 million tons of LNG has to be produced from the currently unsanctioned projects, which means if you count 3 to 5 years before, which means by the year of 2026, 2027, then you have to at least have this much sanctions to fulfill the needs by 2030. We are currently in the quite loose market conditions, and as you will see, even though we revised our LNG demands which is the red line, but still there lives some volumes and some production may be quite struggling to find a home. So there's a potential for the LNG producers considering production shut in or the COVID-19 impacts to be shortened, hopefully anytime soon within this year. Then you could have the balanced markets within this year. Otherwise, then the production shut in is probably have to be considered. Then because the quite loose market conditions and investment or sanctioning delays, which would trigger a potential delays in 2023-2024. So the delays currently happening would trigger the deficit in the global LNG markets in 4 years' time, and tight markets will be continuing unless new projects are sanctioned, just fulfill the gaps between demand and supply. And what does this mean for the gas prices? This chart shows the dotted lines, the 2020 real price in dollar per MMBtu, and this is our base price forecast. And we see that the right line, which is the Northeast Asia spot LNG price, is expected to be below $4 this year, even though the current price level is around 2 or below 2, but taking into account a normal winter, so there will be some price increase in the later of the year. And in Europe, the price level will be around $3. Also, by taking into account a normal winter coming through this year. And Henry Hub price will be around $2. Going forward, the production shut in, especially from the associated gas place, associated gas from oil place, from shale place, they have to be increased to a level above $2 to incentive more of this associated gas to coming back online. And going forward, as we saw in the balance charts, due to the current LNG project sanctioning delays, there will be upside risk in 2024 to incentivize more investments. And as we always see in markets, when there's a deficit or there's tight markets happening, then a lot of investments will just flood into markets. Then in 4 years' time, 4 or 5 years' time, there will be another round of oversupplied periods happening, which will be in around 2027, 2028. When there is a downside risk to prices due to a cluster of projects online around this time. And also we see that the oil price collapse will start to show the impact on gas price or in the second half of this year and in 2021. So the oil indexed gas price in 2021 will be expected below $6. But overall, in the long run, to incentivize enough LNG projects to fulfill the future robust growing LNG demands, a price level of $8 has to be achieved in Asia to make the marginal LNG projects happen and to fulfill market demands by 2030. Yeah, so in the long run, a price level of $8 to meet the long run marginal costs over the break-even price of the marginal projects. Yeah, so that's will summarize my presentation today. Please feel free to ask questions when we come back to the Q&A session at the end. Thank you.
Thank you, Ms. Nan, for a very comprehensive and interesting presentation. I have some takeaways, excuse me, from your presentation.
Yeah.
The low LNG prices has clearly impacted to the supply side.
Yeah.
So please correct me if I made the incorrect takeaway. So despite of new additional LNG capacity by 15 million ton in 2020, which is already under construction because this is already sanctioned, and most of them are in the US except FLNG2. But those new additional capacity will require a DS price in Asia above $5.4 per MMBTU, which are higher than the current market price. And then the second one is, yes?
Yeah, yeah, I can answer this right away. So
no. I mean, yeah, please.
Yeah, so yeah, thanks for the comments. Yes, so this project's already basically approaching to finish, and all their capex are sunk costs. So which means, yeah, basically you have to bring them online.
Yeah, okay. And then the second one is thank you for your confirmation. And then the second one is the low LNG prices will also reduce the new LNG project sanctioned in 2020. If you compare the figures of the new LNG projects sanctioned in 19, for instance, which is 70 million ton, to what we already have now in this year is only around 4 million ton, I think. So clearly there is an impact of the low LNG price to the new LNG project sanction, which will, as you said, make a gap to the LNG supply in the coming future. And then the last one is the low LNG price will then also impact the startup of the new LNG project in Indonesia. Recently, you just mentioned that basically in your presentation you mentioned about $6 for the new LNG project to be sanctioned in Indonesia, and even $8 per MMBTU to support the long-run marginal cost for the marginal project. So this is interesting facts. And then on the demand side, I have some notes that basically while the LNG demand in Europe is quite stable, the European, they prefer to cut the Russian pipeline import due to this COVID-19 rather than reducing the LNG demand. And then the second one is I think this is the interesting one. The interesting one is that the low LNG price has been below the coal to gas or coal to gas switching price, both in Europe and Asia. I have a special note here because you already described that this low LNG price already drive the additional LNG demand for the power generation in Europe, as well as in Japan and South Korea. But I think this is also a new fact for us that we can learn from the situation now. In Indonesia, as we know that we are quite heavily depending on the new coal power generation, which is in the normal merit order, normally in the simple calculation, the 1 kilowatt hour of power generation equivalent to 642 rupiahs from coal. While the gas itself, in the current price of $3, basically the LNG could be cheaper than the coal. This is something that we need to bear in mind, that the new LNG price will change the merit order of the power generation, and we can probably Indonesia can learn from this fact. And on the price side, I think the delay of FID some new projects, mainly in the US, Mozambique, and Russia, will start to tighten the market from now to 2024. I think this will be good news for the supplier. So the low LNG price hopefully will be recovering soon. I believe that all of you has some question to Ms. Nan. Sorry, please post again in the chat provided in the Zoom or in YouTube live chat, because we still have another guest. He is the Singapore-based managing editor for the Platts Asia LNG team. He is responsible for directing Platts pricing and content coverage of regional LNG markets in Asia, Middle East, and India. Excuse me. In particular, the Platts JKM benchmark and the West India marker. Previously, Kenneth developed pricing and new analysis of the coking coal, metallurgical coke, and steel markets in Asia. He is also the frequent speaker at LNG conference in the Asia, Pacific, and Atlantic region. So I'm inviting Mr. Kenneth Fu. Please welcome Mr. Kenneth Fu.
Thanks, Rahmat. Can I check if everyone, you are able to see my screen?
Yes, the slide is okay and the sound is crystal clear. Very good, very good.
Good morning, everyone, and thanks for spending part of your morning, Saturday morning, in this webinar. The presentation that I have is a slightly different tangent towards what Sinan has presented. I think there has been a lot of discussion around FIDs and supply and demand forecasts already. So I perhaps can go on to another angle, which is to talk a little bit about market structures, the global market structures, on pricing as well as on trading and marketing fundamentals. I see that on the YouTube live stream, there has been some questions on how is the JKM assessed, what is going to be the new normal when it comes to marketing of LNG due to COVID-19, and over the next couple of years. I will attempt to answer those questions, but please feel free to continue posting further questions, and hopefully Sinan and I can answer that after my presentation. So just a quick introduction on Platts. We are part of a wider business called S&P Global, listed on the New York Stock Exchange. We are a provider of credit ratings. Our S&P Global ratings arm, of course, provides ratings for the capital markets for global businesses. And we are also deeply involved in LNG liquefaction projects. We have provided ratings for projects in Qatar, in Russia, and in Australia. Dow Jones indices as well. We manage the S&P 500 and the Dow Jones index. And then, of course, Platts is focused on commodity pricing. So we assess key benchmarks like the dated Brent, price as well as the JKM. Just a couple of disclaimers. I just wanted to start off
Hello.
presentation. I'm sorry. I just wanted to start off this presentation by showing a price chart. I think this chart shows it very clearly that LNG prices has been lingering at very, very low levels for a long time. And this decline has been sustained for, I think, more than 2 years. And I think the consensus is that we are very unlikely to see double-digit prices for the next half a decade at least. If you look at the forward curve on the Intercontinental Exchange on LNG prices, the price that you see stretching out to 2026 isn't more than $6. So at this moment, I think the realization that the LNG market is facing is that low prices could be sustained, especially for the near term at least. And it's not just the demand factor that has been an obstruction in terms of price rebound. The supply side has been buffeted by US supply and Australian supply for the last 2 years, most recently from the US. And I think if demand doesn't recover in a strong enough way, there's an expectation that prices could remain at such low levels, at least for the next couple of years. Now, a brief summary on what's going on in the LNG market this year. There are three, I think, portions to focus on. One is on the demand and supply side. On supply side, as I mentioned earlier, the US production has been hitting the market very aggressively. And what's more is that most of this production is uneconomic. Uneconomic meaning that off-takers of this US LNG cargoes are not able to recover their costs when they resell these cargoes to even most competitive markets. And secondly, it is not just US production that has been maintained at a pretty high level. We see LNG producers around the globe, from Qatar, from Australia, even Indonesian producers have been maintaining their output. So this is despite very low spot LNG prices. The reason being is that the term contract prices still remain fairly high in the first quarter of the year, over January to March. And this is encouraging producers not to cut production, even though I think there's a realization that that prices are generally pretty on a fairly low level. There is also, I think, even though prices rebounded from the March lows, I think at one point it was dated Brent was $12 to $13. It has since recovered to $40 at this point. So there is again less incentive, despite very weak fundamentals, for producers to actually cut production, because they are still selling term LNG cargoes at reasonable prices. And this is despite the fact that there are a lot of cargo cancellations and cargo deferments by the end buyers, which I'll go through on the next point. Demand growth, again, I think in the previous presentation, it has been made clear that there has been definitely an impact on demand from the virus. But I think one mustn't forget that demand growth has been slow for a while. In fact, throughout 2019, China in Northeast Asia itself was the only country that really ramped up its demand. And even in terms of year-on-year growth, China's demand growth on percentage basis wasn't really as strong as the prior 2 years. So the new normal could be that I think demand expectations can't be as bullish as before. And the coronavirus situation just emphasizes this point. India, Pakistan, Bangladesh, South Asia continues to be very key regions. But at this point, there's a lot of opportunistic procurement at the moment, taking advantage of low spot prices and even not buying cargoes if the prices don't really work for them. Now, the next point would be there's a lot of structural market disruptions involved. US and European gas markets are under heavy price pressure. The European market, because of a very low pipeline gas prices, and of course Russian gas really creating an issue in terms of price levels. For US gas markets, it's an interesting scenario because of lower oil prices for a period of time in March and April. There was some upside pressure on some of the pipeline gas prices because a lot of US gas production is due to associated gas linked to oil. So there is a negative correlation between oil price and US gas price. If oil prices go down, that means that oil production could be restricted, and therefore associated gas production could be restricted, which leads to higher gas prices. So you do see Henry Hub prices hovering around the $2 level for quite some time, and this is despite the fact that for a period of time, even JKM LNG price, even the European pipeline gas price went under the US gas price, which I wouldn't say is unprecedented, but it's an extremely rare situation. Now, another thing that the LNG market is very concerned about is this disconnect between term contract price and spot price, and that's creating a lot of market deficiencies. I will go through that in a slightly greater detail in my next couple of slides. There is also longer term market uncertainty. FID decisions, of course, has been delayed. Another element that I think we are hearing from buyers these days is that the volatility in Brent prices in the near term has sort of affected the appetite for end users to sign more term contracts. We are hearing feedback that they are waiting for more stability in the forward curve over 2020 to 2023 on the Brent price before committing to even more long-term contracts. Now, just to emphasize that LNG price and crude oil price, the trends are fundamentally different. The fundamentals have disconnected since 2018. So what we do observe is that at least on the spot LNG price, we haven't really seen any big impact from a rapid increase in oil prices, in Brent-linked prices, or a rapid fall in terms of oil prices. And that's because the LNG market has become a suitably liquid and large market of close to 400 million tons of LNG traded, of a reasonable size in terms of spot liquidity and portfolio liquidity as well. So the fundamentals, the pricing fundamentals have disconnected. And this chart just shows that sort of worldview as well, and reality. Just taking into consideration 13.5% of Brent, this is sort of the portfolio average across all contracts if you consider spot LNG short-term, mid-term, and long-term. We think it's around 13 to 13.5%. And then you plot it against your TTF and JKM price, as well as your Henry Hub price. You add the liquefaction fee and you add the shipping to Asia. This is essentially what you get. And you do see that there is some correlation between LNG and European gas. So JKM and TTF, because both prices function is critical for LNG in both basins, JKM for Asia and TTF for Europe. But for Brent, the fundamentals are different. And you see here that there was a rapid narrowing of Brent price, your long-term, your typical long-term oiling price, towards that of the LNG price. But the rebound in Brent price has since stretched this gap once again. So whether the gap is small or big, what we believe is that the fundamentals and the correlation has completely broken down. And the volatility of crude oil prices is also very obvious. But I would say that taken on the longer term, crude oil prices generally isn't this much volatile. I think everyone would agree that across 2019, we have seen fair stability in crude oil prices due to OPEC interventions, due to no significant disruptions to demand. But this year has been a very interesting one for crude oil producers and buyers. When you see at the start of the year, crude oil prices close to $70, falling down to the low teens, and then again rebounding to the current price of $40. So interestingly, typically gas prices tend to be a little bit more seasonal, and you would argue a bit more volatile, but seasonality can't be confused with volatility. But the Brent price definitely has shown greater variance and greater volatility compared to the LNG as well as the gas prices. And just back to my earlier point just now, I did mention that this is dissuading some buyers from signing longer term contracts based on oil, because when they look at the forward curve, based on what's happening on the spot market at this point, it does affect and create wild swings in terms of the forward curve, creating difficulties in hedging, creating difficulties in your price forecast, creating difficulties in trade financing. So that is one factor that I think has been a key feature of the market so far, that is preventing more buyers from signing new oil-linked term contracts. And this slide, I think I need to explain this slide in greater detail, because the forward curve of LNG price. So JKM is the LNG price delivered into Northeast Asia to JKTC, and the price curve that you see is taken at the end of every month. So this is taken just last week, end of May, end of April, end of March, so on and so forth. The months are the front months. So for what is looked at in last week, this is the August, September, and October prices. Year 1, year 2, year 3 would be your 2021, 2022, 2023 price. So what it shows is that really it depends on what's happening in the prompt market at a certain point. So looking back last year, end of last year, the prices were significantly higher than what they are right now. And therefore, the forward curve does show that premium to the current price directly in May. So what is remarkable is that partly because of COVID-19, partly because of US LNG flooding in the market, the forward curve has actually dropped by almost 40%. Or if you look maybe back even further, maybe middle of last year, the forward curve has actually gone down by a quantum of 40 or more. So this is really interesting. And the thing about forward curves is that, of course, the prompt market, which is the spot price, has a very big impact on where people see the forward price. So this $2 plus price could eventually rise if the JKM is pushed up by other factors as well. But I think this goes to show how quickly the market has changed, how fast conditions change, and how impactful has the COVID-19 as well as US supply situation been on the market this year. And this was the forward curve that was published by Platts yesterday, showing the values across the curve until 2023. It does show that your 2020 calendar year, so your average price across this year, is actually a near-term bottom. So if you look at next year's price, traders do expect 2021, the average price of 2021, to be substantially higher than right now. So the current price of $2, I think there's a danger in saying that this price is representative of at least the next several months or next several years. But one must remember that this low price creates a very sharp contango in the market because of such tremendous weakness in the prompt, that this is actually very much depressed. And there's an expectation that prices should recover as, of course, the COVID-19 situation eases, and as US production and Australian production from newer liquefaction projects start to slow down over the course of 2021 and 2022. And I think most analysts would forecast that before the COVID-19 situation actually hit the market, that your 2023, 2024 price would be sort of the bottoming out of the market, meaning that it's expected to be closer to the top. But of course, the uncertainty is more on the demand side, whether the COVID-19 situation would delay even more projects, the FIDs of more projects. Secondly, how impactful this hit in terms of the virus demand has on all economies globally, especially JKTC, Japan, Korea, Taiwan, and China. And thirdly, which is the most important demand side factor, which is China, whether China could sustain its economic growth and industrial demand, its power demand over the next few years, and continue to use LNG to supply its needs. One needs to bear in mind that China has also very big plans to develop its domestic production, its domestic gas supply, as well as its pipeline imports from Russia, from the Power of Siberia project. So China is by no means reliant or totally reliant on LNG. It's probably the only country in Northeast Asia, in JKTC, that has so many different sources of gas. So that's one factor to consider as well. Now, just looking at the demand picture, this is just a simple illustration of imports into the 5 big importers within Asia. When you look at demand side in Asia, you can't neglect India, even though India is only slightly bigger in terms of imports compared to Taiwan. So taken together, these 5 constitutes about 2/3 of global demand. And just looking at the figures of respective imports across the countries, I think it paints a very clear picture that China and Taiwan are the fastest to recover from COVID-19, or is still on the strongest track of recovery. This slide just doesn't show the May figures, but the May figure would show a very similar picture as April. This very strong increase in industrial and power demand, and the imports for May are similarly very strong. But for Japan, as well as Korea, as well as India, you do see a very slow recovery in that regard, probably because lockdown measures have been in place, and a lot of the measures are still in place going into June. One point to take note is that there is a stark fall in terms of demand for Korea and India both on a year-on-year and a month-on-month basis. That can be attributed to the fact that India and South Korea was furiously buying cheaper spot LNG over the first 3 months of the year. So you see that the imports were massive into India and South Korea in Q1. And that was because a lot of the smaller buyers in South Korea and most of the private and state-owned buyers in India was able to take advantage of low spot prices and push up their inventory levels. But what happens when you eat a lot after a very heavy meal? Your next meal could be affected. Your appetite could be affected for your next meal, and we are seeing that in the next month itself, which is April, being substantially affected due to COVID-19, but also because they were running on a very high stock and inventory levels in India and South Korea. I won't go through too much of this slide, but just to remark that what we have seen is that Asia Pacific supply continues to dominate. So despite US LNG being produced in a very fast and furious rate, apart from South Korea, in which you have a little bit more Middle East supply as well, and because of coal gases contract with Cheniere, which guarantees sort of a significant level of US LNG into Korea. The other countries tend to still rely a lot on Pacific LNG. So LNG from Indonesia, from Malaysia, from Australia. And another very key factor why this is happening is because of the freight rate. Because freight rates continue to be quite substantial from the US into Asia. And therefore, it remains very uneconomic for, let's say, a supplier to bring a US cargo all the way to Asia and expect to sell at a very competitive price that is directly competing with Indonesia, with Malaysia on a kind of a price level basis. So we do still see Asia Pacific Asia Pacific supply being the dominant source within Asia itself. And this buttresses my earlier point that US LNG production or supply is a very big game changer in terms of the supply picture. It's more than doubled year on year. But I think this chart shows a very interesting trend that even though it started the year very strongly, US LNG supply has been on a gradual decline. From March to April, it is dropping a little bit, as well as from April to May as well. And that is because of US export cancellations. As mentioned in the very first slide, US LNG exports have been cancelled because they are uneconomic. And we are hearing at least 30 to 40 cargoes that has been cancelled out of the various projects out of the US. And if you look at 30 to 40 cargoes, that's pretty much about 40% or close to half of US LNG exports. So that is a very key sort of phenomenon. And I would say that it's a phenomenon that very rarely happens when you have a take or pay contract and buyers actually prefer to not take these cargoes, to actually cancel these cargoes. So I think that kind of speaks of a very big disruption in the LNG market when buyers find that the pricing doesn't work, when buyers find that because of contracts that were earlier signed and priced that does not make sense at the current moment, they are forced to cancel volumes. We see this happen in a lot of commodity markets past the last few years. One market that comes to mind would be iron ore. Several years ago, when China's economic growth had a bit of a slowdown, Chinese mills or buyers started reneging some of their contracts, which were ironically speaking, kind of a lot shorter than LNG contracts. Where LNG contract is 20-year, iron ore contracts were only 1 or 2 years, and they started cancelling some of these contracts due to the fact that they were not able to make the fundamentals work for them economically. And then there was a switch towards market-based pricing, so switch towards an iron ore index. So similarly, for off-takers of US LNG, the underlying contract is Henry Hub, and then you have the liquefaction fee, the $3 liquefaction fee, $2.50 to $3.25 liquefaction fee. Average could be around $3, and then your freight. And that doesn't really work as well for US LNG buyers in Asia and in Europe. So we see that happening, and I think that is one of the very obvious signs of this traditions or market structures breaking down in the LNG market. Now, what we do observe is that as well, Asian and European LNG imports tend to function in a sort of a disproportionate manner, inversely proportionate manner. So when you have more imports into Europe, what it means is that the supply is being shifted away from Asia, and that concurrently pushes up the Asia LNG price as well. The price of LNG in Europe, while it is very much linked to the Dutch TTF price, is actually not the actual value of TTF. It's actually a discount to TTF. And what we do observe is that just looking at our data by Platts Analytics, just looking through all of the contracts that are currently in play, the contracted volume would peak just before 2024. Of course, this doesn't take into account the likelihood of contracts being re-signed, mid-term, long-term, even short-term contracts. But this just includes even all the MOUs and SPAs and even the HOAs involved. So what it does means is that if contracts are not re-signed, or a smaller proportion of these expiring contracts are renewed, we could actually see more and more uncontracted LNG. So more LNG being available for short-term trading, more LNG being available for the spot market. And that's also another key feature in providing sort of liquidity in terms of the spot LNG market. Whereas 10 years ago, the JKM has been assessed for about 12 years. When we started assessing the JKM about 10 to 12 years ago, the spot market was a meager 1 to 5% of the entire global LNG traded market. But right now, as you can see on the left-hand side of this chart, the spot market, which is represented by the yellow portion, is around 20 to 25% of global LNG volumes. And then you have the short-term. Short-term ones would be anything from 3 months to, I think, 3 months to 1 or 2 years, is another 10%. And then, of course, you have the mid and long-term one, which form the bulk of volumes. But what is interesting is that the spot and short-term space has been growing since 2017 and 2019. And similarly, not just on the contract traded volume, the average duration of contracts have also remained at a low level for a number of years. Now, this is a very interesting scenario because 2018 and 2019, we saw a large number of FIDs, of new projects being sanctioned. And in order to sanction new projects, of course, you need to sign long-term and mid-term contracts. And that really pushed up the longer-term contracts signed over the last couple of years. And that meant that the average duration of the long and mid-term contracts, so it doesn't include the spot and short-term ones, were also pushed up. But again, with the uncertainty that we have right now on low spot prices, on very volatile crude prices, uncertainty in demand, uncertainty in supply as well, there could be a general reluctance to continue signing very long contracts, both in the midterm and in the long-term space. Now, just going into the question that was asked on the YouTube stream just now about how spot LNG prices are being assessed. It is being assessed in the same way as the other very commonly used benchmark in oil and in the LNG term contract space, which is dated Brent. So it uses the market on close assessment process to underpin the assessment. So within Asia itself, there are two key prices. Of course, the most popular one is the JKM. There is also a fast-growing West India marker that is currently being used to price domestic gas sales within India itself. So on this slide over here, you see the biggest domestic gas producer, ONGC, pricing their gas on the West India market for LNG that is delivered into West Coast terminals. Of course, within India itself, the East Coast is the more active production hub, whereas the West Coast has most of the LNG terminals. But the fact is that domestic gas and LNG, because they are competing directly in the Indian domestic market, there is a need as well for suppliers of LNG, or rather suppliers of domestic gas, to reference a LNG price. So this is actually gas on LNG pricing rather than what you see typically in the other contracts, the LNG on LNG pricing. So we have seen, I think, a very big sea change in terms of LNG price usage away from oil usage in the short-term space. So when I say short-term, it is anywhere between 3 months to 3 years. If you are a trader and you come into the market, or an end user wanting a cargo within the next 3 years, the chances are you will be signing it on a JKM linked basis. Now, what is still growing, but not growing as much, would be the midterm space, the midterm and the long-term space in terms of JKM adoption. It is still dominated by oil-linked contracts, although that is changing. We are seeing some new importers like China's Yudian LNG, Yuedian, buying 16 cargoes over the course of 4 years linked to JKM. And then you have also the LNG producers of the US. Interestingly, the feed gas suppliers into Cheniere also use JKM in their contracts, primarily because Cheniere has volumes that are sold to Asia, and a lot of those as well use Northeast Asia pricing like the JKM. So it's just connecting your sales price as well as your procurement price using the very same benchmark, which is an LNG benchmark instead of Henry Hub or Brent crude. As mentioned earlier, the process that we use to assess the JKM is the market on close. So the very definition of that is that it is a process that allows transparent, verifiable, tradable information to form the basis of the benchmark itself. And it reflects market values at the close of the trading day. So JKM and a lot of other Platts benchmarks like Data Brent, for example, have a close at 4 p.m. or 4:30 p.m. Singapore time or London time, because we believe very firmly that price is a function of time, and therefore in bulk commodity markets, you have the market on close process as being the most important rather than a daily average. And that daily average pricing system is usually used for sort of hyper liquid markets such as in US gas markets. And these are the specifications for the JKM market on close process. I shan't go through every single term in the essence of time, but just want to note that the delivery location is still fairly flexible. It is for delivery into Japan, Korea, Taiwan, and China, which with the buyer's right to substitute into any port in any of these 4 countries. Quality is as well is fairly broad, 10:30 to 11:30 as well.
Thank you.
And there is in terms of participation in the market on close process, we have seen a very sort of active contribution to the data that we receive every day. And these are the companies that have been approved to participate in the formation of the JKM price. So 35 to 40 companies have been approved to participate, and about 2/3 of them are active. So I would say about 20 plus of them are active. And this is a mixture of end users like PetroChina, like JERA, your portfolio majors like Shell, BP, Total, as well as your trading houses like Trafigura, Vitol, and Glencore. So I would say that this represents the bulk of the spot market trading in general, perhaps around 2/3 to about 80% of volumes are traded by the companies that you see here. And volume is fairly liquid as well. And since we started the firm assessment process for MOC in 2018, we have seen about 2,500 bids, offers, and trades so far. About 5 to 6, if you take it on an average basis, that comes up to about 5 or 6 bids, offers, and trades on a daily basis. And liquidity, of course, varies. When you have a liquid trading month or liquid trading period, liquidity can actually rise up to very high levels of even 16 to 18 bids, offers, and trades on a daily basis. This is just one example. So the screenshot that you see here is the world's most transparent pricing process. The MOC that is hosted on the Intercontinental Exchange. And it's a product called the Platts e-window. And it is transparent, it is real time. If you're a commodity trader, chances are you would have used this trading any product from gasoline to naphtha and now to LNG. And this was a day, I think, earlier this year, quite a fairly liquid day where we had 17 or 18 bids and offers. As you can see, the market participants there are considered to be the more active LNG traders like BP, like Trafigura, like Onji, and then you also have end users like SK from Korea under their subsidiary Prism. And then on the supply side, you have Vitol as well. Now, one of the fastest growing trends in the LNG market is not really in the physical space. It's more on the financial side. And we have seen volumes grow on a very rapid level since 2017. Last year, at the end of 2019, there was about 110 million tons of JKM derivatives that was cleared on either Intercontinental Exchange or Chicago Mercantile Exchange. So if you take that as a ratio of the physical, that would be about close to a third. And this year, we have seen continued growth. So year to date, from January to May, it's been around 90 million tons. So I think at the end of this month, we will exceed the entire volume in 2019. So the expectation is that the LNG derivatives market could grow to very well the same size of the global LNG physical market by the end of this year. And why that is important as well is because of the need to hedge your physical exposure. I think one of the reasons why a lot of companies still prefer to sign on a Brent link basis, on dated Brent or on JCC, is because there is a long derivative forward curve that they can refer to, and that forward curve can stretch out all the way to 10 years on oil, and it's fairly liquid as well. For LNG, this is developing, and the volumes are definitely developing as well. So definitely it doesn't match up to that of your most active oil contract like ICE Brent. But the fact that it can go to at least the same size of the physical market by the end of this year suggests that going forward, the visibility of your long-term price, if you are linking to JKM, as well as your ability to hedge these physical cargoes, these physical volumes on a underlying financial contract, which is the JKM derivative, could actually be strengthened considerably. I'll spend the last couple of minutes on my presentation. I just don't want to hold all of you back too long to enjoy your weekend on a very interesting development, which is the LNG bunker market. And alongside small-scale LNG, the LNG bunker market is one of the very new segments that a lot of people in LNG talk about, especially over the last couple of years. Of course, this year, more and more people are talking about hydrogen, but we can save that for another time to discuss. So on LNG bunkering itself, the most active LNG bunker port actually is not anywhere in Asia, despite the fact that Singapore has had bunkering capabilities for a while. But Singapore's capabilities are just restricted to truck-to-ship bunkering, meaning that your barge or your tugboat has to go to the jetty, and a LNG truck has to load the LNG onto the ship itself. But for Rotterdam, liquidity has grown immensely, and we do think that the next benchmark for LNG bunkering could actually start in Rotterdam, because there is both truck-to-ship bunkering, there is also ship-to-ship bunkering. There are 30 to 40 LNG companies that are trading LNG bunkers in Rotterdam, in Europe, on a very regular basis, both in the ARA region and in the Baltic region. So we do think that there is very big potential for Rotterdam to become a global LNG bunker hub first. And secondly, I think within Asia itself, as you can see in the slide over here, in this table over here, there is some sort of developments in terms of Asia, about Pavilion, about Singapore MPA, and then you have a new bunker vessel from Shell and Fuel LNG. So these are very welcome developments, but I would say that in terms of growing traction, the I think trading market could actually start in Rotterdam itself. So Platts has a couple of assessments. One of them in Singapore and one of them in Rotterdam. And just to look at the price spread between the bunker prices compared to the LNG prices and the gas hub prices, clearly there is a difference. For Northwest Europe LNG, that's the European LNG price, versus the European bunker price. The gap is fairly steady, around $2 per MMBTU. And if you compare that to Singapore, Singapore bunker versus Singapore LNG cargo cost is substantially lower. So this speaks of the fact that Singapore LNG bunker operations are still definitely not as mature as that of its counterpart in Rotterdam. And that really speaks of kind of a very significant steps that Singapore might need to do in order to catch up to become Asia's bunkering hub. My final slide gives an illustration, a picture of how LNG for bunkers has become a lot more competitive than your marine fuel prices. So just looking at low sulfur fuel oil, your IMO compliant low sulfur fuel oil, and your LSMGO, your low sulfur marine gas oil, the discount is massive. And there's an expectation that the economics could work very well for LNG. The only barrier to LNG bunker development, in my view, is infrastructure build up. But the cost of LNG, if it continues to be sufficiently low priced, could actually be a rather than an inhibitor, actually a driver for more adoption. So I've come to the end of my presentation. Please let me know if you have any questions, or if you'd like to ask these questions to me directly and privately, do drop me an email and I'll be happy to answer them. Back to you, Rahmat.
Thank you, Mr. Fu, for the insightful presentation. I made some notes from your presentation, which basically confirm Ms. Nan's presentation. The first one is the LNG price, such as Henry Hub and now JKM, as the already well known in Asia region, has disconnected from the oil price. That's the fact that probably we can take a benefit for the supplier. And then there is also a limited impact of the demand to COVID, but the low LNG price is more affected by the supply glut from US, Qatar, and Australia. The next one is the borderless LNG movement, and the bigger spot portion have converged the ASEAN and European price, and even now with the US price. The last one, I think, which is the very interesting one, is the development of LNG bunkering. As you mentioned in the final slide, the LNG price is very competitive compared to the low sulfur fuel oil and LMGO. This could be an opportunity for Indonesia to develop the future LNG development, and also to unlock the potential supply in the future. Now, I will open the Q&A session. As the moderator, I have the privilege to ask the question first. So, Ms. C and Mr. Wu, with the current pandemic, will there be a new normal in the global LNG business that will affect the supply demand balance? That's the first question. And the second one is, following the disconnection between the oil price and LNG price, will there be a new trend in terms of formula, indexation of formula in the contracts? And since we already have some contracts ongoing, is there any potential for a negotiation contracts, either for the pricing terms or a non-pricing adjustment? I think I will start with those two questions. Who will start? C first, perhaps, or?
Yeah, I'm just muting myself. Sorry. Yeah, thanks. It's very good questions. The first one, will there be new normal in the LNG supply and demand balance? I would say the currently new normal is like people start signing contracts, LNG contracts through online channels. They will see that between China and Malaysia, they started signing contracts online. But in terms of the LNG supply and demand, new normals, as we saw, combining with the second question on the pricing formula and stuff. So if we look back the history, 10, 20 years back, so every single time there was like a historical large event like oil crisis and stuff, then there was some pricing formula, or these factors would affect LNG supply and demand factors. Events would trigger some new norms in the market, like the S-curve pricing formula from the linear pricing formula, like long time ago, from like 60s, 1960s and stuff. And yeah, going forward, that was the S-curve. Then it's more like the pricing formulas indexed to multiple commodities like historically in oil, then on gas itself, and we have seen coal price indexation. So yes, there will be no new normals, and then the supply and demand balance. So as you mentioned, Rahmat, that the COVID-19 impacts on demand is regarded a little bit shorter term focused, but on supply side is a longer term focus, because you have to invest in your facilities, your projects 3 to 5 years ahead to make sure that volumes would come online at that time. But on demand side, even though it's short-lived events relatively, but also people would think like how to negotiate the contracts and how to sort of manage their infrastructure, like regasification schedule and stuff. So I think, yes, there will be new normals. And second, will there be renegotiation contracts either on pricing and non-pricing adjustments? I think so, yes. Historically, with, yes, as just mentioned, we have formula change indexed to different commodities. And also in terms of the non-pricing thing, the destination clause was almost removed of them in the newly signed contracts. And I think, as Ken has mentioned as well, there may be a waiting time for the two counterparties to sign new contracts. But I would say discussing or renegotiating existing contracts are ongoing. And we have heard quite a few requests from research and consulting customers in rest of the energy to ask for advice on pricing levels, on term levels, and apparently there are active movements in the markets to, negotiate a better deal for both sides. Yes.
So it's good news for you.
Always busy.
and probably there will be a next online World Gas Conference or something like that in the future. I don't know.
Yeah.
Okay, Mr. Fu, please.
The new normal for me personally would be the fact that people need to accept that the market is changing in terms of flexibility. So flexibility is the one thing that buyers will want after in times of uncertainty. That is the number one thing that people want, right? And the anathema of flexibility would be in a long-term contract, 20-25 years, without much chance of constant price review, with very fixed volumes, with very severe take or pay penalties. So I think that's something that suppliers will need to compromise, definitely, because the good thing about buyers is that they are negotiating from a position of strength for the next couple of years. And everyone is saying that it's going to be a buyer's market. It is true. If you look at the prices, that could be true for once in many years, because LNG has been sort of a market that suppliers have quite a lot of negotiating strength for a while. So I think that is one thing to consider in the sense that in terms of flexibility, if you as a supplier you're able to give more flexibility in contracts than your other competing supplier, then you might be able to move more volumes. Secondly, about the pricing scenario, of course, speaking from a Platts point of view, because we don't just assess LNG price, we assess dated Brent, which is a very well used price in contracts as well. So in terms of the use of whatever price benchmark that the market has, we encourage them to have free say in doing what they want. But we are also a believer of market-based pricing and economics of pricing as well. In terms of looking at the market, LNG is the only liquidly traded bulk commodity market globally that prices itself off another commodity that's not an upstream product, that's not downstream, or even very related in the supply chain. It used to be when it was competing in a fuel mix against naphtha, for example, against fuel oil years ago. But right now, oil isn't that strong competitor anymore. So I think there will be a shift towards LNG pricing, but it will take a while. I personally believe that I think the market will shift to a hybrid model first, meaning that it won't be 100% LNG price. It might be, let's say, 30% LNG price, 40% oil price, and then the rest would be on a fixed price or whatever basis. So before moving on into a fully commoditized commodity, such as your coal, your oil, or whatever, there will be a transition stage in terms of pricing. So that could happen before I think the market gradually shifts towards full indexation, full LNG indexation.
Okay, thank you very much. Yeah, so that's what is happening now. I think the hybrid of formula that is getting increasing now. Then I already collected the question from the chat in Zoom and also in YouTube. So I have 3 questions here. First is this is the question for Ms. C. That how will the additional 15 million ton of LNG still flow in 2020? Perhaps you already explained this is the project that already sanctioned. But what is interesting is you list down the some liquefaction projects in your table to watch in 2020 and 2021. What do you think will be the scenario for those projects? And then the next question is to both of you, I think, is the question is, as a matter of fact, now that the gas is becoming abundant, the shale gas revolution, the new LNG plant coming. So from the supply side, there is no issue in terms of LNG market. That's what I can say. But what will be the our strategy to attract more demand? To attract more demand, especially for the midterm and long term, to attract to sustain the supply from the upstream sectors. The next one is everyone here is wondering. It is good to have the view from the people from outside Indonesia. As you know, that the government already set the policy of capping the domestic price as at $6 per MMBTU. So how will this $6 per MMBTU price cap will impact the demand in terms of power and industry in Indonesia? And do you think is it the right decision or not? I mean, feel free to comment on that. Of course, you may not change the story, but good to hear your view on that.
I'm not going to comment something bad on Indonesia government policy.
No, I mean, at least what will be the impact?
Thanks. They are very good questions. The first one, the additional 50 million tons coming into the markets. As we briefly mentioned, they are already sanctions. They are approaching completion phase. They would have to come online. But at the same time, we have seen some providers or some operators cutting down or shutting in some productions from trains of their projects. But the thing is, in the liquefaction parts, there's no linear correlation between how much you like per unit production and per unit costs decline. it's not a linear correlation, which means by bringing down some volumes, you have to still pay a bundle of fixed prices on supply side. So it doesn't really make sense to reduce your capacity utilization. That's why a lot of liquefaction projects, even though they're losing money, they're still running max capacity, because if they switch down some production, they may lose more. That's one thing, and but there's a correlation between how much Asia can take, how much Europe can take, and also if the LNG how much can replace pipelines from Russia, from Norway, from Africa in Europe, and how much, as Ken mentioned, China can take this year. But if, let's say, both Europe and China are full with LNG imports, then I personally think LNG production has to be restrained this year. So eventually it won't be 50 million tons. From the new projects, probably yes, but they have to make a choice on the existing ones. The second one is the gas revolution. What will be the strategy to attract more demand? So on the supply side, two things are very important for LNG suppliers. One is upstream costs, how much you spend on producing a unit of gas feeding into your LNG plant. So that part for Asia, I would say, is economic, and for Middle East is economic, but in US and in Canada, probably not the case. But we also have seen, like, US started cooperate with upstream operators and just bring down some costs on their end. But in terms of that's one point, upstream cost, and the second one is how much revenue you can get from the liquid parts. So if you combine these two together, then you can come down to a reasonable actual costs on the supply side. Then Indonesia, Malaysia, let's say Indonesia has very good relationship with the traditional buyers from Japan, from Korea, and from China, from Taiwan. Then first, historically good relationship, and second, if the cost can be reasonably brought down, then I think going forward, the attraction will be flexible contract terms, shorter term, more shorter term contract volumes coming online. I have my statistics here from our database. So historically, more than 20 years, like term contract were the popular ones. But shifting from 2016, the majority was signed with 11 to 19 years duration. And with 5 to 10 years, for the contract that were signed in 2014, 15, 16 were the most, but less than 5 years contracts are starting having taking the shape in the contracts. So shorter term contracts and flexible hybrid indexation, and also in terms of the slope, depending on the market's view of the signature year and also the years going forwards. Then, for example, for the signature signed in 2014, then you would expect 15% of the slope. But if you sign a contract this year, you probably can negotiate a 10% slope. Yeah, so I would say for Indonesia, it's already quite good track records. And the next is on the pricing, on the flexibility and duration part. And the last one of the opinion of government policy at $6. So Indonesia government is still is pushing forward of the coal developments. That I would say it makes sense because security of supply on the power sector that is the highest priority. It's not only in Indonesia, you see that in Japan. Coal is quite important in Japan as well. Nuclear is important, and gas is important. And due to the COVID-19 this year, there are some like vessel the people working on vessels on boards, and they may have the danger to get affected. Then people start worrying, okay, our gas LNG storage only lasts for 2 weeks in Japan, and should we stay away from LNG and put more gas, put more coal and nuclear back online? So it's more like a dynamics between this fuel switching. And one thing is on the cost side, $6 per MTU in Indonesia domestic markets, as I've seen from the cost point of view, 6 is not cheaper. Of course, it's not cheap, but on the sort of a realized price this year, 6 is a relatively reasonable price for Indonesia. But going forward, how much CO2 emissions that Indonesia government wants to cut, and how much subsidies that government would like to give to cut these emissions, that would definitely affect coal price and also the dynamics between coal, gas and renewables. Yes.
Mr. Fu, now is your turn.
Yeah, I'll just, in the essence of time, I'll just answer that final question on the $6 pricing. I think it's a very rational approach taken by the Indonesian government, and it's an approach that has been taken by a lot of developing countries that are still formulating its gas commercialization strategy. So we have seen it happen in China. India as well has a very well established ceiling and floor price for domestic gas sales. So it's not something new what the Indonesian government is doing. I think what is crucial as well is that a fixed price can be quite risky for suppliers of gas, clearly, because your procurement costs could vary when you're buying gas from the international market, and when you're selling gas as well, competing with the international market. So there may need to be some periodic reviews on whether this $6 can actually vary in order to reflect market conditions. And as Sinan mentioned as well, if this $6 could actually constrain the construction of new LNG, new gas projects in Indonesia itself, and really restrict domestic production, then that could actually be a risk. To add on to that, I think it's very important for LNG to be kept cheap as well. If Indonesia wants to develop small-scale LNG, and of course, cost is just one facet of the entire puzzle. But because small-scale LNG does have advantage of lower initial investment cost when coming to comparing to conventional LNG. So it's a very flexible sort of method. And of course, Indonesia is very, across the Asia-Pacific region, Indonesia is the country that sort of needs it most because of all these older oil-fired power plants. So the pricing of that and the commercialization strategy needs to, of course, take in consideration the development of small-scale LNG.
Okay, interesting. So probably that will be beneficial for the future development of the future supply LNG project from the new small-scale development of the demand in Indonesia. So apparently, I don't know, Kenneth, do you mind to share your presentation now, or you will update it later on after you make some revision?
Yeah, I can share my.
Yeah. Sorry. Go ahead.
Yeah, I mean,
yeah, sure. I can share my slides, but I need to do some edits. Yeah, I'll send you later.
Yeah, take your time. I mean, so this is good news for the audience, I think. If they are ready to upload it now, then you don't leave the chat room first, because if you don't mind, you can upload to the put in PDF and upload to the chat. Is that okay, or do you prefer to send to the organizer first?
Yeah, I think I will do some edits and send to you.
It's okay. It's okay. And then we will do the sharing presentation after the event then. So so for the audience who wants to have the presentation stay a while after the events, I mean they will upload the presentation later on. So apparently 2 hours has passed in this webinar. I kindly invite both of you to deliver the closing remarks. You can start. Lady first.
Okay. Yeah, but I think it's a very, very good session, and I'm very impressed to see so many participants in the Indonesia Gas and Services Society. It's much more than what I thought. Yeah, but thanks a lot for the session. I actually learned quite a lot from Kenneth as well. Thank you.
Yeah, of course. This is just the starting, and then the next we hope to see you again. Kenneth, please.
Yeah.
Something to share.
Same from my side as well. I think the key insights that I would like to impart is that the LNG market is definitely changing, and the pace at which a lot of these contractual kind of norms, structures, pricing, trading factors has changed very rapidly over the last 2 or 3 years. So maybe a year from now we can have the same presentation, and we'll be talking about totally different issues and different trends. So that kind of shows how quickly I think things change. But I think it's important to also look at fundamentals and look at the fact that in terms of markets, what's important is the liquidity, flexibility, and in a way transparency. And with that, I wish everyone a nice and relaxing weekend ahead, and thanks for spending time tuning in.
Yeah, just add to what Ken said here. So on the fundamental part, we used to do analysis every year, like once a year we do the review, and afterwards we do every half a year. And now we do every month, and I see we are coming to a weekly analysis soon, even on the fundamental parts, and rebalance our global demand and supply. That's that's the new norm on the work side. Yeah,
that's true. I mean, the age of negotiation now is getting shorter. The validity is getting shorter as well. I mean, yeah, this is what's happening now.
Yeah.
Okay. I have some interesting notes as the closing remarks. So the COVID-19 and the low LNG price not only put pressure to the supplier of the LNG, but we think that this is also creating the opportunity to the wider utilization of the LNG for power generation, industrial sectors, and new potential demand, particularly for new coal, new power generation, and then transportation and bunkering. As we conclude from this discussion, the gas with a least carbon footprint energy now has become more affordable and accessible, so that the usage of gas in Indonesia should be able to be increased, which is aligned with the IGS vision. To wrap up this event, I would like to thanks again, big thanks to Ms. Sinan and Mr. Kenneth Wu for your presence and delivering a fantastic presentation. Also special thanks to the Chairman of IGS, Pak Didi Sasongkowidi, the Board Advisory of IGS, Pak Hari Karyuliarto, Ibu Yeni Andayani, Pak Johardi, Angga Kusuma, the other IGS committee here, Pak Salisa Aprilian, Pak Teni, Pak Wiko, Nadia, and Budi. And of course, not to forget the big thanks to everyone who joined this event. We'll see you in the next IGS event, so don't forget to subscribe the IGS YouTube and follow our Instagram page for more updates and information about our upcoming IGS event. Thank you for sharing your time with us. Have a good weekend. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Thanks, everyone.
C and Kenneth, I think if you still have time, do your homework. You can put the updated presentation.
Sure.
You can share in the chat for someone who is interesting and keen on your presentation.
Okay, sounds good.
Thank you again, C and Kenneth.
Yeah.
Thank you.
Thank you.
See you next time.
See you.
Dan penuh keberanian. Tak pernah menolak tantangan apapun.
Wes pan penting kabeh pokoke wes.